In today's unpredictable market, where the stock market is strong and real estate seems invincible, there's a looming sense that a major crash is on the horizon. It's almost like we're standing on a precipice, just waiting for the other shoe to drop. While some experts call it a recession, where economic growth declines over 2 consecutive quarters, what we're really facing could be much worse: a depression. A depression isn't just about declining growth. It's when the economy is limping along at a fraction of its potential, like when the GDP should be at 4% but is stuck at 2%. But here's the intriguing part. Why is it that during economic downturns, some people seem to come out on top while others are left struggling? It's not luck. It's about mindset and preparation. Today, we're diving into the mind of Robert Kiyosaki, a man who didn't just survive the 2008 financial meltdown. He thrived, turning the crisis into a billion-dollar opportunity. Recently, Kiyosaki has been sounding the alarm about an impending asset crash. But while that may seem like doom and gloom to most, he sees it as a golden opportunity, an opportunity for those who are ready to make millions. So, is an all-out crash on the way? And more importantly, how can you turn this potential disaster into your advantage? Let's dive in. Think back to 2008. Almost everyone remembers the chaos. Lehman Brothers collapsed, Bear Stearns imploded, and the stock market took a nosedive. The fear that gripped the market back then still lingers in people's minds today. The difference now is that people might be a bit wiser, having lived through that financial nightmare. But here's the kicker. While most people were panicking, hiding away like cockroaches, Robert Kiyosaki was making more money than ever before. Yes, you heard that right. He made more money after 2008 than at any other time in his life. Kiyosaki isn't just some pessimist predicting doom for kicks. On the contrary, he's excited. Why? Because where others see disaster, he sees opportunity. He's practically giddy at the thought of all the bargains that could flood the market during a crash. To understand why Kiyosaki is so confident, we need to step back and look at the history of market crashes. The stock market has always been a roller coaster, with euphoric highs that make investors feel unstoppable, followed by terrifying lows that wipe out fortunes in the blink of an eye. Take the dot-com bubble of the late 1990s, for instance. Investors were throwing money at internet companies, convinced that the future was online. They weren't wrong, but they were overly optimistic. Companies with no real profits were being valued in the billions simply because they had a .com in their name. It was a frenzy, but like all frenzies, it didn't last. In March 2000, the bubble burst. Companies that were once Wall Street's golden children became worthless overnight. Even Amazon, now one of the world's most valuable companies, saw its stock price plummet by 90%. It took Amazon 7 years to fully recover, and they were one of the lucky ones. Many companies from that era never made it back. Fast forward to 2008, and the story is eerily similar. The housing market was booming, with everyone buying up real estate like it was going out of style. Banks were handing out mortgages left and right, often to people who couldn't really afford them. As long as house prices kept climbing, it didn't seem to matter, until it did. When the music stopped, house prices started to tumble, and the entire system unraveled. The financial crisis that followed was the worst since the Great Depression. But while most were losing their homes and jobs, Kiyosaki was strategically positioning himself to make billions. So what's the secret? How did Robert Kiyosaki manage to come out on top while everyone else was floundering? The answer lies in his understanding of crashes as opportunities, not disasters. He didn't see the 2008 crash as the end of the world. He saw it as a chance to buy valuable assets at rock-bottom prices. He knew the market would eventually recover, and when it did, he would be sitting on a fortune. If you're finding this video helpful so far, don't forget to hit that subscribe button and give us a thumbs up. Your support helps us bring you more content like this, so subscribe and join the Economic Hero community today. One reason we haven't seen a crash as severe as 2008 since then is the Federal Reserve's role as a safety net. The Fed has several powerful tools to prevent a complete economic collapse. For example, when the economy shows signs of slowing down, the Fed can lower interest rates, making borrowing cheaper for businesses and consumers. This encourages spending and investment, which in turn stimulates economic growth. A prime example of this was during the 2008 financial crisis, when the Fed slashed interest rates to near zero to boost the economy. When lowering interest rates isn't enough, the Fed can turn to quantitative easing, essentially printing money to buy government bonds and other securities, pumping liquidity into the financial system. After the 2008 crash, the Fed launched several rounds of quantitative easing, injecting trillions of dollars into the economy. This move helped stabilize the markets and kept the recession from getting worse. However, these tools come with significant risks. Quantitative easing, while effective in the short term, can lead to inflation. We saw this play out after the massive QE programs during the COVID-19 pandemic, when the US experienced a surge in inflation, reaching levels not seen since the early 1980s. Prices for everyday goods skyrocketed, eroding purchasing power for millions of Americans. If inflation remains high, the Fed could find itself in a tough spot during the next crisis, unable to lower rates or print more money without making inflation even worse. So, what should you do if the market crashes? There's an old saying in finance, don't try to catch a falling knife. This means you should avoid buying assets that are rapidly losing value because they might continue to drop, leading to significant losses. But Kiyosaki has a different approach. He sees crashes as golden opportunities to buy, as long as you know what you're doing. Kiyosaki doesn't play by the traditional rules. He's an entrepreneur, not an employee, and he believes in using debt to his advantage. While most people are taught to save money, get out of debt, and invest in the stock market, Kiyosaki does the opposite. He buys gold mines, silver mines, real estate, and hotels. He's a capitalist who believes in using debt to build wealth, not avoid it. And during a market crash, he sees the stock prices of fundamentally strong companies plummet, creating opportunities for those who are prepared. But timing is everything. If you buy too early, you could see your investments lose even more value before they start to recover. This happened during the dot-com crash, when investors who bought into tech stocks too soon watched their portfolios shrink as the market continued to slide. It took years for the market to bounce back, and some companies never recovered. Kiyosaki believes that silver is the most undervalued investment opportunity right now. Unlike real estate, which he thinks is overpriced, silver is trading at around half of its all-time high. Silver is used in everything from electronics to solar panels and electric vehicles. As the world shifts toward green energy, the demand for silver is expected to soar. Despite this, most investors are still focused on the stock market, overlooking silver's long-term value. Silver has stood the test of time, maintaining its value over centuries, while modern currencies have come and gone. Kiyosaki argues that silver is affordable for most people, and that its price is bound to rise as demand increases. By investing in silver now, you could be positioning yourself for significant gains in the future. The key takeaway here is that making millions during a market crash isn't about trying to predict exactly when it will happen. Kiyosaki has been warning about a crash since 2011, and while we've seen downturns, the stock market has more than tripled in value since then. The point isn't to time the market perfectly, it's to be prepared when the next crash inevitably comes. Whether that means having cash on hand to buy assets at a discount, investing in commodities like silver, or simply staying calm when everyone else is panicking, the opportunities will be there for those who are ready. Crashes are a natural part of the economic cycle, and they don't have to be something to fear. In fact, they can be the perfect time to build wealth if you know how to spot the opportunities that others miss. Just remember, before making any major financial decisions, It's always a good idea to consult with a financial advisor who can offer personalized advice based on your situation. But if you're willing to learn from Robert Kiyosaki's experiences and prepare for the next crash, you could find yourself in a position to make millions when everyone else is losing their heads. So, is an everything crash coming? Only time will tell. But one thing is for sure, those who are prepared will be the ones who come out on top. And with that, don't forget to like this video, subscribe to Economic Hero for more insights, and hit the bell icon so you never miss an update. Thanks for watching.